Hello everyone! Today, let's talk about the gap up and fade pattern in the stock market. This is a common short-term trading pattern, especially suitable for intraday trading and short-term operations. Understanding this pattern can help us gauge market sentiment and price movements, allowing us to make better buy and sell decisions. What is gap up and fade? Gap up and fade refers to a situation where the stock opens significantly higher at the start of the trading day, but throughout the session, the price gradually declines, closing lower than the opening price. In other words, the market appears strong at the start, but over time, selling pressure takes over, causing the price to retrace. Characteristics of the gap up and fade pattern. The opening price significantly higher than the previous day's closing price, with a large gap up. Gradual decline during the session, where buying pressure weakens and selling pressure starts to dominate. Closing price lower than the opening price, forming a reversal pattern, indicating market weakness. How to handle gap up and fade. Monitor volume. The gap up and fade pattern often occurs with increased volume, especially during the price retracement. If volume continues to rise during the decline, it signals heavier selling pressure, which might indicate a short-term sell signal. Set stop loss points. If you bought the stock at the higher opening price and notice a retracement, don't hesitate to set a stop loss to avoid further losses. It's crucial to act quickly to minimize the damage. Short-term reversal signal. Sometimes, a gap up and fade can also signal a short-term market adjustment. Investors can use other technical indicators such as RSI or MACD to confirm if there's potential for a reversal. A divergence signal might indicate a possible bounce after the retracement. Example. Let's say a stock closes at $50 the previous day. The next day it opens at $55, a nearly 10% gap up. However, after opening higher, the stock does not continue to rise but instead gradually falls. By the end of the day, the stock closes at $52, showing the gap up and fade pattern. Looking at the chart, we can see that the price fell from $55 to $52, indicating that the initial optimism didn't hold. Even though the stock opened higher, the buying momentum wasn't strong enough, and selling pressure took control, causing the price to retrace. In this case, if an investor blindly chased the price higher at the opening, they might have faced losses due to the retracement. Therefore, it's essential to set stop-loss orders in advance to protect against significant losses.